Have you ever wondered why your tax refund might suddenly feel like a stimulus check? Millions of Americans are about to find out when they file their 2025 taxes in early 2026. Experts say a refund surge is coming, and for many households, it could mean hundreds or even thousands of extra dollars back in their pockets. But here's the twist. It's not because you worked harder or paid less throughout the year. It's because of a powerful tax change that quietly rewrote the rules behind your paycheck deductions. What makes this story even more fascinating is that the surprise refund is baked into the system. Payroll departments across the country withheld taxes based on the old rules, never accounting for the brand new deductions passed halfway through the year. That mismatch means you've likely been overpaying without realizing it, and when you file, the IRS will be cutting you a bigger check. Stay tuned because I'll break down exactly who qualifies, how much you could see, and why these refunds will look different in 2027. The foundation of this refund surge is President Trump's One Big Beautiful Bill, passed in July 2025. It represents the most sweeping tax overhaul since 2017, and it's set to reshape the way Americans file in early 2026. JP Morgan's forecast already projects the average tax refund will climb to $3,743, about $500 higher than last year's refunds. That's a 15% jump, and for many families, that extra cash could cover bills, groceries, or even feel like a mini stimulus injection into household budgets. Of course, averages can be misleading. Some taxpayers will pocket far more than the $500 bump, while others will see less, depending on whether they qualify for specific deductions. But one thing is consistent. The changes are designed to be broad enough that most working Americans, from seniors to tipped workers, will notice the difference. Understanding why this is happening, though, requires digging into how the tax system actually works, and why overpayments are suddenly turning into a financial windfall. At its core, a refund is simply money you overpaid. Every paycheck, your employer estimates how much tax to withhold, and at the end of the year, you compare what was taken out with what you actually owed. If too much was withheld, the IRS sends the difference back. This year, payroll systems withheld using the old rules for months, which means millions of Americans have been sending in more than necessary. Here's the kicker. The One Big Beautiful Bill backdated its new deductions to January 1st, 2025, even though the law wasn't signed until July. That creates a mismatch. Imagine your overtime earnings should have cost you $1,500 in taxes under the new rules, but $2,000 was withheld under the old ones. That's a $500 overpayment automatically added to your refund. Multiply that effect across overtime, tips, state taxes, and other deductions, and you can see how refunds are about to jump in a way Americans haven't experienced in decades. This isn't just a one-size-fits-all benefit. Different groups are positioned to gain in different ways. Seniors are among the biggest winners, with a special boost to their standard deduction. If you're 65 or older by December 31st, 2025, you'll enjoy an additional $6,000 deduction as a single filer, or $12,000 if married and filing jointly. That's a direct reduction in taxable income, meaning more cash staying in your pocket when refunds come due. Another major group are tipped workers. For decades, servers and bartenders struggled with how much of their tips got taxed. Under the new rules, they can deduct up to $25,000 from taxable income, drastically cutting their tax bills. Over time, workers also benefit with new tax-free treatment for part of their extra pay, while families see expanded child tax credits. High-income tax state residents win from expanded SALT deductions, and car buyers who choose American-assembled vehicles gain with a brand new auto loan interest deduction. Each group's win looks different, but the result is the same: larger refunds and a happier filing season. The new no tax on tips rule is one of the most groundbreaking changes. It allows up to $25,000 in deductions for tipped income, but only if your income stays under certain thresholds. Single filers making less than $150,000 and married couples earning less than $300,000 get the full benefit. The deduction starts shrinking above those limits, vanishing at $400,000 for singles and $550,000 for married couples. This ensures that the relief is targeted at everyday workers who rely on tips, not the very wealthy. Over time, workers also get a fresh break. Under the new rules, half of the time and a half pay rate is now tax-free for federal income tax purposes. That means if your base rate is $100 per hour, the extra $50 in overtime pay escapes federal taxation. However, it's important to note that this benefit doesn't exempt you from Social Security or Medicare taxes, nor from state taxes in most cases. Still, for millions of Americans working long hours to make ends meet, this deduction means bigger refunds and stronger take-home pay in the future. For years, taxpayers in states with high income or property taxes complained about the SALT deduction cap, which limited them to $10,000. That ceiling hit families in places like New York, California, and New Jersey especially hard. The One Big Beautiful Bill more than quadruples that cap, lifting it to $40,000. That's a dramatic shift that will allow many households to finally write off a much larger share of what they pay to their state and local governments. The difference here isn't just about bigger refunds, it's about fairness. For middle-class families in high-tax areas, the old cap often meant they were effectively paying taxes twice, once to the state and once to the federal government on the same dollars. Now, with the expanded SALT deduction, those families will feel real relief. Combined with the other changes, this adjustment could deliver thousands of dollars back to households that have been shouldering the heaviest tax burdens for years. Another quiet but meaningful change is the child tax credit increase. It rises from $2,000 to $2,200 per qualifying child. That extra $200 might not sound like much at first glance, but when multiplied across millions of children, it represents billions in additional tax relief. For a family with 3 kids, that's $600 more refunded compared to last year. Money that can help with everything from back-to-school shopping to medical bills. The eligibility thresholds remain the same, $200,000 for single filers and $400,000 for married couples filing jointly. That ensures the credit continues targeting working and middle-class families rather than higher-income households. The credit's design makes it straightforward, no complicated itemization required. Families who claim the standard deduction still qualify, meaning broad participation and wide impact. It's a small change with a large footprint, directly boosting refunds for millions of households with children. For those planning to buy a car, there's another brand new perk, a tax deduction for interest paid on loans for American-assembled vehicles. Buyers can deduct up to $10,000 per year in loan interest, provided the car was assembled in the United States and purchased new in 2025 or later. This deduction applies to both single and joint filers with income caps of $100,000 and $200,000 respectively. This is more than a tax break. It's a push to strengthen domestic manufacturing. By tying the deduction to U.S. assembly, the policy encourages Americans to buy cars built at home, supporting jobs and industries in states like Michigan, Ohio, and Kentucky. For families already struggling with rising auto loan costs, this deduction provides both relief and incentive, reducing taxable income while promoting American industry. With an estimated 117 million refunds, averaging $500 higher, the math is staggering. That translates into nearly $60 billion flowing back into household budgets all at once. Economists predict that surge will act like a nationwide mini-stimulus, boosting spending and lifting GDP by an extra 0.5% in the first quarter of 2026. From retail sales to travel and services, The impact of those larger refunds will ripple through the economy quickly. This isn't just theory. History shows that when Americans get larger refunds, they tend to spend them. Whether it's paying down debt, upgrading household goods, or simply catching up on overdue expenses, that cash gets circulated fast. In a time of economic uncertainty, the refund surge could provide a welcome shot in the arm, helping stabilize growth as families breathe a little easier with more money in hand. Here's the part most people won't expect. 2026 refunds will look big, but 2027 refunds will likely shrink. That's not because the government is clawing anything back. It's simply because payroll systems will update. Starting in 2026, your employer will withhold less from each paycheck in line with the new rules. That means your take-home pay will rise steadily throughout the year instead of showing up all at once at tax season. So in 2027, when you file for the 2026 tax year, your refund will look smaller compared to the year before. But in reality, you'll have already enjoyed the benefit in larger paychecks. Understanding this timeline is critical so you don't panic or feel blindsided. The 2026 refunds are inflated because of backdated deductions, but going forward, the system will balance out. Think of it as a one-time windfall followed by a permanent boost to your paycheck.